Welcome everybody to 7 Minutes with SEACEN. I'm Glenn Tasky, the Director of Financial Stability and Supervision and Payments and Settlement Systems at the SEACEN Center. The COVID-19 pandemic has wreaked havoc on public health and economic growth all over the world. In addition to the unbearable human toll, tens of millions have become unemployed around the world, entire economic sectors have imploded, and tens of thousands of micro, small, and medium-sized enterprises have shut down. Remarkably, the financial sector has largely shown resilience. Central banks worldwide have intervened to lower interest rates, increase financial asset purchases to maintain liquidity in the markets that banks depend on for borrowing from each other, and created new lending programs of their own. Central banks and standalone bank regulatory authorities have allowed banks to draw down their capital and liquidity buffers. Some regulators have prohibited banks from paying dividends or buying back shares or paying bonuses, all in the name of preserving capital. Some regulators have taken a flexible attitude to the application of expected credit loss approaches to determining loan loss allowances. Liquidity has so far not been an issue, as in many jurisdictions, retail deposits have flowed into the banking system from non-bank financial institutions, and deposits have also been created along with the surge in lending from government-sponsored programs. Still, there are concerns amongst banks and their regulators over possible significant increases in non-performing loans upon the expiration of some of these government-sponsored programs. And if a substantial increase in non-performing loans does take place, the specter of pro-cyclicality looms large. Pro-cyclicality means different things to different people. Different financial observers have a different opinion, but the usual definition goes something like this: the financial sector, or more narrowly the credit cycle, or the business cycle begins a downturn. The downturn negatively affects the profitability and ultimately the capital adequacy of banks. Banks respond to their weakened condition by cutting back on lending, thereby reinforcing the downturn in the financial sector cycle or business cycle. In other words, we can say that banks respond pro-cyclically. What causes pro-cyclicality? A downturn in the business cycle raises the prospect of higher expected credit losses in the future, as firms face declines in demand and don't pay back their loans. Under the newish expected credit loss accounting standards, this effect is most pronounced at the onset of a downturn, because it's precisely at this point that the future macroeconomic and sectoral scenarios all look much more negative than before. If collateral factors into the calculation of required loan loss allowances, declining collateral values can also increase the size of the mandatory allowance. Higher expected credit losses, in turn, require higher loan loss provisions to build up the stock of loan loss allowances so that they will cover the higher expected losses from the loan portfolio. The higher loan loss provisions diminish profitability, which negatively affects capital adequacy. Rising non-performing loans may also diminish profitability in another way, by reducing the interest income that banks record each period. The result is that bank capital either declines if the bank actually incurs a loss, or rises more slowly than before. But that's not the only reason recessions tend to reduce capital adequacy. Lower or more slowly rising capital in the numerator of the capital ratio is often accompanied by an increase in risk-weighted assets in the denominator. There are two reasons for this. First, the probability of default increases, increasing the expected loss on a loan. And for those banks that rely on credit ratings of their borrowers for risk weighting, external credit assessments are inherently pro-cyclical. Next, the range of possible outcomes widens. There is a greater chance of an extremely unfavorable outcome than before. This increases the unexpected loss on a loan, widening the capital requirement, since capital exists to protect banks against unexpected losses. Now, how do banks respond to declining capital ratios? The evidence isn't clear. It depends on how well capitalized the banks are to begin with. But for those banks operating just above minimum requirements, the tendency is to deleverage, that is, make fewer loans and sell securities or other assets to reduce the capital requirement. All of these actions are pro-cyclical in that they may exacerbate the real sector downturn. How else do banks behave pro-cyclically in downturns? If the downturn starts in the financial sector, that is, an end to the boom phase of a financial cycle, quite often securities markets freeze up. When securities markets freeze up, banks cannot assess the value of securities that they demand as collateral when lending to other banks. And if the collateral are mortgage-related securities, chances are delinquencies have risen and real estate prices have started to fall, decreasing the value of these securities and diminishing banks' borrowing capacity. When banks can't borrow, they have fewer funds to lend, causing a spillover from the financial sector downturn into the real sector. We've talked about how banks and the broader financial markets behave in a pro-cyclical manner. Banking regulation, in the form of risk-based minimum capital requirements and accounting and/or regulatory requirements to establish adequate loan loss allowances, can promote this pro-cyclicality. But how else could regulation, supervision, or other actions by the financial sector authorities exacerbate pro-cyclicality? One possibility is by encouraging or prescribing the use of the same models for calculating regulatory capital requirements and loan loss allowances. We've already discussed how capital requirements and loan loss allowances can be pro-cyclical. There's a lot of academic research out there on whether this or that method is more pro-cyclical. For calculating capital requirements, the point-in-time method is thought by some studies to be more pro-cyclical than the through-the-cycle method. For calculating loan loss allowances, 12-month expected credit loss has been judged as more pro-cyclical than lifetime expected loss, but other studies have not found significant differences. Capital and provisioning models lead to pro-cyclicality even if they are not prescribed by the regulator. The financial system is reflexive in that the beliefs of individual banks about uncertain future events do shape outcomes, and widespread use of similar models can shape rather than measure reality. As one expert put it, models are an engine, not a camera. And that's 7 minutes from SEACEN. Thanks for watching.